All right, let's dive right into this absolutely incredible story of a high-stakes trading session. We're going to get a front row seat to a market collapse that literally wiped out thousands of dollars in just a matter of minutes.
That's the sound you just heard, a professional trader reacting in real time as he watches his colleague lose a ton of cash. So, how did it all happen so fast? And more importantly, what does it teach us about the brutal reality of the markets? To really get what happened here, we've got to go back. Let's rewind to the beginning of the trading session and see how this all unfolded on what started as a seemingly ordinary but, yeah, very tense Friday morning.
Okay, so the story kicks off on September 5th, 2025. The market is sending out some extremely mixed signals, and you can just feel that traders are on edge.
So you've got this powerful contrast playing out. On one side, you have major indices like the S&P 500, what traders call ES, and gold hitting record highs. But on the other side, you've got some really worrying economic news from the latest employment report. It creates this incredibly tense environment where the market feels stretched thin, and everyone, everyone, feels like a big move is coming. So, in the middle of this volatile environment, our trader, who's actually live streaming his whole session, has a very clear and, you could say, very risky strategy. His words are super simple, but they pack a punch. He thinks the market has climbed too high, way too fast, and he's planning to bet on it falling from its peak. You know, this is what's called shorting the market. Now, to really get his thinking, we gotta talk about a key concept called resistance. Just think of it like a price ceiling. Our trader sees the market is already bumping its head against this level, he calls it R2, and that just reinforces his belief that it's about to turn around and head down. And on the flip side of that ceiling, you have support, which acts like a price floor. A falling market will often hit a support level and then bounce, and we are absolutely going to see this idea of a price floor, S2, come into play in a very, very dramatic way a little later on. And then, 9:30 a.m. Eastern hits, the opening bell rings, and all that calm, strategic planning, it's immediately replaced by pure unfiltered chaos. The first few moments are just a blur of frantic price moves. You can hear it in his voice. His immediate reaction tells you everything you need to know about the kind of volatility he's seeing. He says it's jumping. What he means is the market isn't moving in a smooth line. It's lurching. It's skipping price levels entirely. And this is the kind of wild action that can either make you a fortune or just completely wipe you out.
And then it happens. The moment he was betting on, the market drops. But it happens with a speed and a violence that absolutely nobody was expecting.
And this is it, the absolute climax of the morning. In what he literally describes as the blink of an eye, the NASDAQ index collapses by 300 points. This is just a massive, violent move that shreds right through the market. To put that speed into perspective for you, a major move that can sometimes take hours or even days to play out happened in less than 10 minutes. The market didn't just pull back, it fell off a cliff.
So the crucial point here is that all control is gone. This isn't some strategic, orderly pullback. It's a panic. The market is just plummeting, and there are absolutely no signs of it slowing down.
As the dust starts to settle, the focus suddenly shifts from the market's wild drop to a fellow trader's quiet, pretty devastating loss.
And that right there is the human cost of all that volatility. In just a few moments, another trader in the room lost thousands of dollars. Poof, gone. And this is what leads us to the most important lesson of the whole day. So you might be asking, how did he lose so much so fast? Well, it all came down to the specific tool he was using. See, he was trading these high-risk mini contracts. With those, a 30-point move against you cost you $600. But if he had used the lower-risk micros, that exact same move would have only cost him $60. His risk and his losses were amplified 10 times over.
And that's the core lesson here, isn't it? In the heat of the moment, the tools you use are just as important as the direction you bet. For an account that isn't massive, one wrong move with a mini contract can be game over.
So what this all comes down to is pretty simple. Using the right size tool for the job can be the difference between a manageable loss you can recover from and a financial disaster that takes you out of the market completely. And it really leaves us with this one final big question. You can have the most brilliant strategy in the world, right?
but it means absolutely nothing if your risk management, your discipline, can't help you survive the chaos long enough to actually see it through.